Good morning, ladies and gentlemen. Let me, first of all, wish you a very, very happy New Year. I'm very sure that our common wish for this year is a good year for the global community and the world economy in particular. There are still a lot of uncertainties hanging around the world economy. This morning, as usual, we begin our first meeting this year with Alan Sinai. He has been with us during the last almost 20 years. I don't think he needs a long introduction to this audience since he has been with us many times before. He is currently the president and the global economist for the Decision Economics, which is based in New York and Boston, Chicago, London. I would consider him as really an economist of all seasons. He has been teacher, analyst, forecaster, investor, everything. But he was awarded many times for his very accurate forecast and the financial market, particularly financial market analysis. You know, I think it was Paul Samuelson a long time ago said, advised fellow economists to say that never forecast economic outlook unless you're really forced to do it. If you're forced to do it, don't ever give numbers. And if you have to give numbers, don't give dates. Don't never give both. Then you never go wrong, you know. Something will happen sometime anyway. But in any case, Alan Sinai has been very, very courageous forecaster. He not only gives numbers, but also dates. Actually, during breakfast, he just showed me a number for his forecast for Korea this year. Exactly on the point, 2.7% growth rate. He said it last year, and he forgot, so he is just on the ballpark. Anyway, so he really has been awarded with the various the prizes for his very accurate forecast. He is particularly good. He is, mathematical model builder, but he is really never as an armchair economist. He really knows financial market mechanisms, interactions between real economy and financial markets. I think that's really his strength, and for that reason, and Time magazine once wrote regarding him, it says, anyone who thinks economics is a dismal science has never been treated to the vivid commentaries of Alan Sinai. He really get down on the real world issues, and he analyzed very, very accurately. Well, with no further ado, I'd like to invite Alan Sinai. He will tell us a lot of things about global economy and the outlook for the future.
Well, that introduction leaves me with a very hard act to follow. I think I should quit when I'm ahead here, and thank you so much for that very kind introduction, for so many of you coming here this morning, and for the graciousness that always awaits me early in the new year here in Korea, where I tend to start. And indeed, it is a new year, and so I thought I might use a New Year's celebration paradigm to talk some about the major dimensions of the U.S. and global economic and financial market outlook for this year. Is the glass of wine. We couldn't serve wine here this morning. We did ask, but everyone thought a little too much wine starting the workday would not be appropriate here in Korea. Is the glass half empty or half full? You know, the half full glass of wine is the optimist, blue sky. Certainly in the U.S. and the world for the last 5 to 7 years, that's been tough to be optimistic. And we have quite a few pessimists still in the U.S. and world about the outlook. That's the glass of wine is half empty. The pragmatist, and that's me, doesn't think about it, just drinks the wine. So I want to use half full and half empty as a way of describing some of the dimensions of the coming year, and I think 2015 as well, as it applies to the U.S. and global prospect, economic prospect, and risks. And it is half full. Long life, long and better times and better expansion ahead for the U.S., for Asia, for Korea, even for Europe, and yes, probably China as well. And I want to use the half-full glass of wine to apply to Japan. And our catchphrase for Japan sounds a little like I have been brainwashed by Prime Minister Abe. We have for some time said that Japan is back in the game. I think the Prime Minister says Japan is back. Governor Kuroda, in a speech I heard him, he's the head of the Japanese Central Bank, speech I heard him give on September 30th in Washington, said Japan is back. I wasn't sure whether I was listening to Prime Minister Abe or Governor Kuroda. But both of them saying the same thing sends a message to the world of financial markets, the world of business. The Japanese policymakers are on the same page to try to achieve much more aggressive and active growth in Japan and to really change what has been a up to this year, 2-decade lost period of time for the Japanese. That means more competition with Korean manufacturing companies because of a weaker yen. A yen that I think when I was here last year I described as headed for well over 100 against the dollar, and I wasn't going to look back on the fundamentals until we got well over 100 on yen dollar. That, of course, implied strong yuan against the Japanese currency as well. I know I said that. I certainly, when I went to Japan, I'm quite aware that I said that. The yen dollar was about 80 to 85 at that time. Our latest forecast on dollar yen, as an aside, is over the next 3 to 5 months, 110 to 115. And so I do think the yuan will go higher against the yen over that time. But if Japan, as the third largest economy in the world, gets that growth rate up and inflation stays above zero, then through trade and the umbrella of increased growth from that very large economy, the South Korean economy will benefit, as will all the other Asian economies. This notion is part of the view that we have that the U.S. and global economy will have better times. So the wine glass for Japan, half full, optimistic. I have to say that until 2.5 years ago, if I would have used the wine analogy to Japan, it was always half empty. I was very pessimistic on that country's prospects. Very different now. And for Europe, emerging from an austerity-induced long 2 as much as 4 years, depending on the countries, debt, financial and economic crisis, emerging from austerity, still in the difficult strait, the wine glass is half full. For equity markets around the world, perhaps maybe even Korea this year, the Korean stock market, the wine glass is half full. Well, is there anything at this time of the year that I'm going to hold up a wine glass to and say it's half empty? Because everything I've said so far is positive. The answer is, and I'm amazed, looking at the distribution of risks around the world and where, because forecasts in some sense can never be right, where it might be wrong, it'll be better, I think, than our basic prospect. Where the wine glass is half empty, if not empty, I'm sad to say, is in the United States and in the governance function of Washington, where I and I think others are convinced that the U.S. political system is broken, badly broken, dysfunctional, struggling, no solutions in sight. And there, my choices on the wine are half full, half empty, or empty. 3 choices. On Washington and its dysfunctionality, empty. In the long run, what I've just said, if roughly right, in terms of how we govern our country and how the political system works in the United States, that is, frankly, deadly. So in the United States, in a prescriptive way, as an observer, as an analyst, as a citizen, I hope we can do something about what I've just said. I'm convinced that Washington will not fix itself, that it's systemic and endemic. I would say this quite clearly to investors around the world. The U.S. is a wonderful place to invest. We had a 30% gain in the U.S. stock market last year. We're projecting another 10 to 15% this year. But relatively speaking, looking around the world, when I see a country whose political system is as messed up as is the United States, that is something all investors have to take account of. So the scorecard on half, and I'm sorry, I usually carry wine with me to these talks and walk out in the audience and pour more than a half, depends where I am. In France, it's a full glass. In Italy, you got to give them 2 glasses of wine. In the United States, we're so health conscious, nobody wants to drink. I don't know what they're missing, and I did miss New Year in Korea. Last year we were in Vietnam around the New Year's time, and they were drinking a lot of wine in Vietnam, both in Ho Chi Minh City and in Saigon. That country was really on the move, very, very enthusiastic and cheery. So I apologize, I don't have any very good wine to pass out, but send me an email, and I will, unless I get 150 requests, I'm going to ship you a bottle of my favorite wine and tell you to enjoy it. I want to go into some of the details of what I've said and not just qualitatively give you these perceptions about the future, because in our work a lot of research and yes, some numbers go into it. And first, the U.S. And global economic prospect. Global to us is 47 countries, about 93% of global output that we monitor, forecast, and analyze. Korea is one of those. We do not pretend to be experts on Korea, and particularly in this audience, where so many of you are part of institutes that spend a good deal of time and do very, very fine analysis on Korea. I would be kidding you if I said I called myself an expert on Korea. We got lucky last year. I think I told this audience about 3% growth, and maybe you could do better. Our number actually that was 2.7, and I'm bragging here a bit because we didn't get all those forecasts right last year, for sure. And 2.7 looks like it's kind of what Korea will do here for 2013. Next year, we're not quite as optimistic as is the government and as perhaps the Bank of Korea. We're in the 3.5% range, but that's a big pickup on a GDP basis from 2.7. And indeed, for the U.S., we are talking about a good-sized pickup, renewed growth in the United States, GDP basis, 2014, 2.8%. This past year, we will be about 2.3. I think when I was here last year, I was talking 2 to 2.5. So we kind of got the U.S. GDP forecast. China, we felt would not have a hard landing. They did not, at least as they produced the numbers they produce. Real GDP growth, we kind of got that for China. China's had a very tough year for a lot of reasons. And we were very bullish on Japan because of the coming expected huge quantitative easing that we thought the new Bank of Japan governor would bring, since that's what that governor advised Prime Minister Abe. Abe appoints Kuroda. Kuroda advises Abe. Why would anybody think that Kuroda would do anything different from what he advised Abe to do? And indeed, we got an inflation target of 2%, a plan to double the monetary base, the massive downtrend in the yen that we had been projecting for a couple of years, huge downtrend in the yen. I'll go to Tokyo next, and my dollar is worth 40% more now than it was a year ago. That very expensive part of the world will not be so expensive. I am delighted by that. And so, but I don't think Korea is so delighted by that big decline in the yen against the won, and I suspect there are countries in Europe, perhaps Germany, and who are a little annoyed by that huge decline. As an analyst, as an outside observer, I must tell you, I think Japan had no other way out. The currency, which was way overvalued, which was giving a competitive advantage in terms of equilibrium to Korean manufacturers, really had to come down, and it's got perhaps a long way to go. So the message for everyone here who's tied to the manufacturing side here in Korea, get your costs down, make better products. The Korean products are wonderful. Keep on selling hard all over the world, and the increased growth that the third largest economy will bring to the world economy, the increased growth that will come from that half-full glass of wine of the United States, the sideways movement of the Chinese economy, up a little bit in growth, and a turn from recession, a difficult and deep financial and economic set of problems for Europe, a turn to small positive growth, plus, behind it all, what I call the fifth pillar. I just named 4 pillars of strength for the U.S. and global economies looking ahead. Renewed growth in the U.S. Japan is back in the game. China, sideways to higher in growth. Europe moving from recession to a small expansion. But behind it all is the power of easy money. The power of easy money. In the business and financial cycle, we are still in the stage where major central banks around the world are very accommodative, and because inflation is generally low in almost all countries, it is very low here in Korea relative to the Korean inflation target of 2.5% or so, central banks can afford to keep their foot on the gas. That means better stock markets with lags. Better stock markets mean more spending, stronger sentiment. Yes, it means for the countries where monetary policy is aggressively easy, probably a weaker currency. That's the case of Japan. But it's all part of promoting growth after a period of 5 to 8 years of nothing but difficult times for the U.S. and the world, economic and financial crises almost everywhere, a long period of time of a half-empty glass of wine situation. What I'm saying today is, I believe we have and are emerging from that cloud over the world economy, the risks of the past, into a more normal period of growth and expansion, where there may well be, I think there will be more upside than downside surprises as we look at the macroeconomic risks to the basic prospect for the U.S. and the world, the lineup, more positives than negatives. That's the first time in this is 2014, the beginning of 2014, we began to get very pessimistic on the outlook for the U.S. and what that would mean for the world back in 2006. 8 years, right in the ballpark of what Reinhardt and Rogoff in that monumental book, This Time is Different, have said is the timeline, how long it takes for countries that go through financial crises to begin to pick up and recover. So my perception and expectation, given the pessimism and the legacies and hangover of human nature, looking at the past, which has been so difficult, is that most are too pessimistic, too afraid to take risk. I see that with all the central bankers I talk to, they're scared to death of inflation, but we don't have any terrible inflation around. If you're in business, you can take some more risk. If you do that ahead of your competitors, you'll win in financial markets. A zero return on cash and equivalent it's not true here. There is a positive real return on cash and equivalent in Korea. But in Japan, a zero return, in the U.S., a zero return on cash and equivalent. From an asset allocation point of view, it's unacceptable. The returns, even in Korea on the stock market last year, I think something like 2 or 3%, is better. Not so much here, though, because it's almost equal. It's better than what you get on cash. Investors can and will take some more risk as we go out. And everybody's worried about bubbles. And there aren't any significant bubbles anywhere. And that tells me we're moving into a stronger phase of expansion, U.S. and worldwide. Markets will do well. And we are a long way away from the next recession anywhere in the world that will, in a major way, affect the world. We're in the upside, sustained and growing stronger U.S. and global expansion that probably has another 3 to 5, maybe 6 years to go in terms of looking at the functionality of the innards of the various economies around the world. In the U.S., we are in the 5th year of our recovery/expansion. Another 3 to 5 years would get us close to the longest expansion ever in our history, which was the 1990s. That was 10 years long. And with that expansion came the greatest equity bull market of all time. How does that happen? Economies grow, sustained way, fairly free of inflation issues, central banks supportive, earnings rise, interest rates are low, fundamental valuation tells you that stock prices should go up. Everyone's scared, and they go up more than anybody thinks. That's early in the functionality of financial cycles. Economies lag better financial markets. The lags before economies pick up to lower interest rates and a lot of availability of credit are long. The lags in response to sustained increases in the stock market are long. The lags in response to a lower currency are long in terms of trade flows. But after a while, it begins to hit. Then the economy picks up. Labor markets get stronger. Central banks begin to get less accommodative, as the U.S. has started. They then begin to raise interest rates. And even then, the expansion goes on. Then the excesses come, and price inflation of goods and services comes. Central banks begin to fight that, and the seeds of the next downturn are sown. This, what I've described in about a minute, takes years in economic real time to happen. And we still think we're in reasonably early stages of that expansion.
It's going to be now long, positive. It's a wave, and businesses need to take advantage of it, and investors need to take advantage of it. So it's another half-full glass of wine. Sorry to be this optimistic here, this early in the year, to an audience that probably thought I was going to spoil their breakfast. But I can't do that. When it comes to the equity market and asset allocation, the glass of wine is half full. The best is yet to come. The best is yet to come. I said that in June, that we were kind of having a quasi-correction in the United States. The S&P 500 ended up 30%. We will surely have corrections and comeuppances. There will be a 10 to 15% correction in the U.S. stock market. It will ripple around the world. It will probably come when people think our Federal Reserve is going to start to raise interest rates. They are telling us that's not going to happen for a long time. If what I say is roughly right, it may happen sooner than most people think. Stock markets will adjust, and you still will need to buy. So let me, having painted this broad brush picture of the U.S. and global economy, just give you a few numbers, and then I want to move on to talk about the Federal Reserve and quantitative easing, because not just the U.S. Federal Reserve is doing this, so is Japan, so might Europe still might go to some kind of quantitative easing. The UK has done it. It's a new way of doing monetary policy. We think it has worked and is working. And of course, when a country engages in quantitative easing like Japan, the initial effect is a weaker currency, and how long Japan's going to do this means something to won yen, to dollar yen. So you need to be aware of this path and process of quantitative easing that's going on in other countries that touch Korea so much. The U.S. Expectation we have is 2.8% real GDP growth in 2014, up from about 2.3% this year. The 2.3% has come from a surge in growth in real GDP toward the end of the year. Fourth quarter real GDP growth in the United States was a little over 4%. Huge increase in inventories, which is not sustainable. And the fourth quarter track, having started at about 1%, is now running about 2.5%, and is coming from strength in consumption. Sound familiar? In terms of what is being thought about Korea. That, because the U.S. as the number one biggest economy in the world, is going to affect the world, the stronger growth. Over 3% in the second half of the year. It's actually pretty much what the Federal Reserve had forecasted quite a while ago in terms of second half growth. When you look at the U.S., you need to take out of a real GDP growth forecast like the one I gave, federal government purchases. We have a rare situation in our history. Federal government purchases are shrinking in real terms. They're shrinking in real terms because in the U.S., despite the clumsiness of the process and politics of Washington and the fights and the kind of perils of Pauline, well, you're all too young to know about the perils of Pauline. Let's see, when I was a youngster about 100 years ago, I grew up in Detroit, Michigan. A very interesting place to grow up if you could survive with your life in Detroit. You were lucky, and I did manage to survive. But we would go to the movie theater on Saturday, and there were serials. Movies. It's kind of like what they do on TV now, Breaking Bad, that kind of thing, where you look at it week to week, Homeland, those kinds of things. In the movie theater, there's something called the Perils of Pauline. Pauline was a lady. And she was always getting into fixes and troubles, and we'd leave the theater after an hour and a half, and she was hanging, in a tunnel where a train was going to come through, and we thought the train would kill her, and that, was the end of that Saturday's kind of peril. We'd come back the next week, and guess what? She managed to somehow escape the moving train. The tunnel suddenly closed up, and the train never got through, and she was off on her next adventure. Perils of Pauline, that's what I mean. By that. That's kind of been what the world has been through. But in our case, and that's what Washington looks like, because what I'm about to say about federal government outlays and the shrinkage, fiscal restraint, they're forever. Not really forever, but for a long, long time. That's a kind of austerity in the U.S. Federal government outlays are shrinking in real terms. The last time we saw this was in the 1990s after the end of the Cold War, when the U.S. shifted from a defense-based economy in a lot of ways to no defense. We had a huge decline in federal government purchases. Our budget was better. Economy inflation was lower. It had a lot to do with that. Very unusual. This is going on. It's going on because of the Budget Control Act of August 2011. That was $1 trillion of caps on discretionary spending set by the administration and the Republicans, despite all the fighting. The talks, as you know, broke down. But that was set into law. Then we had this crazy sequester, which was designed to get the politicians to agree on a big budget deal. They couldn't agree on it, and the sequester came into place. The Republicans actually liked it because it shrunk the government. President Obama and the administration didn't like it. But the sequester, $1.2 trillion, was the law, cut in a very blunt way federal government outlays. And then something called the fiscal cliff, which had been resolved by the time I got here last year. The fiscal cliff ended up with a $400 billion hike in taxes for upper income families in the United States. It's almost $3 trillion of fiscal restraint. Clumsily arrived at lots of fighting, lots of perils of Pauline, cliffhangers in Washington, markets very volatile. Oh, you must have been aware of this. Everybody in the world was. But at the end of the day, $3 trillion of deficit reduction over a 10-year period, a grand scheme. The number was $4.5 trillion. That's what President Obama and the Republicans wanted. They just couldn't agree on the nitty-gritty of it. The fiscal cliff, had it happened, would have taken $7.5 trillion out of the economy over 10 years, and we would have had to forecast a recession. Thank God we didn't get the full blunt of the fiscal cliff. That would have solved the debt problem, but that would have given us another recession that would have been very severe. And if we did nothing, U.S. sovereign debt, the U.S. would be having a debt problem. We might have to go and ask for money from the IMF. No, that's an exaggeration. That won't happen. Don't worry, your Treasury bond holdings are safe. But $3 trillion turns out to be, in a clumsy way, kind of an ideal number. Not too much, not too little. And that's what's in place. And it shows up in federal government purchases in the GDP accounts, and that is arithmetically subtracting about half a percentage point of real GDP. So real GDP, as a consequence, isn't the right summary measure to use to describe to anybody about the state of the U.S. economy. The right number to use is ex-federal government purchases. And we're over 3% in the private sector, ex-federal government purchases. The private sector, the economy is 70% consumers. The fundamentals are improving. Jobs, not great, but improving. The unemployment rates come down. Income maybe is going to rise, not as much as it used to. The wealth effect will kick in this year. Consumer sentiment is picking up. Interest rates are still low. The financial condition of households, as we measure it, is back to pre-crisis equilibrium. Financially ready to spend if they want to spend. That's the household sector. So the consumer spending, we're thinking, will grow at about 2.5%, 2.75% real, and that's behind the 2.5%, the 2.75%, 3% view, and it is driving, will drive the private sector. Business capital spending should pick up. That should help Korea. We are more competitive than we used to be on exports. The dollar probably goes a little higher. The private sector is in much better shape than those real GDP numbers that I gave you. That's renewed growth from the U.S., and we buy a lot, as you know, from Europe. We buy a lot from Korea, from Asia. That helps the exports of those parts of the world. Asia, lifted by Japan, this year's growth rate for us, 2.5% to 3% real growth for Japan. We're counting on the Bank of Japan to do more to get that number. We don't think Japan will get its inflation rate up to 2% all that quickly. It is already 1.2% on their preferred measure, and they still have over a year to go on their quantitative easing. We think with a consumption tax coming in, a sales tax, the Japanese economy will weaken, inflation will not keep going up, and the BOJ, not now, not a couple months from now, maybe 3 to 5 months from now, will have to come in with more stimulus. Why do we think that? Whenever the Japanese economy weakens, if the Japanese policymakers are surprised by that, or they don't get their movement up to 2% inflation, there will be a policy response, either monetary or fiscal, to lift the economy. Why do I say that? They're all on the same page. Japan has to get out of that 2-decade rut. Abe appoints Kuroda. Kuroda advises Abe. They think alike. The Ministry of Finance is along for the ride. They are on the same page of policy. That's like a put on the economy. They're going to be there to lift it, and unless there's some oddball shocks that happen in the world or come out of the U.S. or come out of China, Japan is going to grow more because they'll make it happen. That's why they're there, and there's unity at the top, so far as I can tell, in Japan. And so that will affect and help with lags, trade flows, including Korea's, a loss in competitiveness, depending on what goes on with the yuan, does not appear, though inflation is low enough here for the central bank to cut rates. We'll see what the central bank does. The fundamentals of Korea suggest, to me, a stronger yuan. Growth is picking up. Inflation is low. Unemployment rate is low. The fiscal side of the ledger looks pretty good. Very competitive country that normally, compared to the United States, a stable government. Maybe not everybody will agree with that. Whenever you're in a country and you talk about politics, no one's happy. No one's happy with their politicians, with their government. Am I? You just heard me say that Washington is broken, and I can't see how it's going to be fixed. And I'm telling investors, think about that when you invest in the United States. So I'm an American citizen, so of course it looks bad to me. We look like Italy to me. We've got more parties, splinters in parties, than almost Italy has. And Italy is one of the most chaotic political places you can ever see in your life. This is a piece of cake here. It's so stable here in Korea. And so the exports of Asia should do better. China sideways to up. Asia then will buy a lot from Germany. Germany's doing pretty well. And Germany levers Europe in terms of the trade, plus Germany's in pretty good shape anyway. Their growth rate's pretty puny, but should do better. Chancellor Merkel will be back. Somebody should have told her, be careful when you ski, even cross-country. It is a dangerous sport. I'm still skiing. I love to ski. They have a Formula One racer. He crashed into a tree. You probably read about that. And he was in great shape, and he's in an induced coma. So for those of you who like to ski, just be careful. Where were her friends and family around when she was out there skiing and she hurts her pelvis? That's not a good thing to happen when you're older. Thank God I haven't had it happen to me yet, but our bones get more brittle. That's one of the big risks, by the way. Chancellor Merkel isn't able to get up and going after 3 weeks. Who knows what will happen to Germany then? I'm only joking about that. So, and Europe is for us. Last year was down almost 1% in the Eurozone. Up this year about 0.5%, maybe 1% at most. But we think Europe needs more stimulative policy on the monetary side. Mr. Draghi is not quite promising it. Well, he's promising it in words, but we think it needs to be backed up by lower rates and maybe some form of quantitative easing, because Europe, with that debt overhang, debt doesn't go away. The trick is not to get into it in the first place. The creditors will never let you go. And so the history of debt, well chronicled by, in some wonderful work by Carmen Reinhardt, Ken Rogoff, and Reinhardt, is ultimately debt is written off, restructured, inflated away, because it doesn't go away. And we do have a lot of countries in Europe with a lot of debt, and it will take years and economic growth that is not in the cards to get rid of that debt. So we're not through with the European story yet, but on a growth basis, things should be better. And then the central banks, and let me go to quantitative easing. For us, a major theme, well over 2 years ago, we thought everybody would do it. It's, of course, very controversial. Quantitative easing is buying securities in the open market by the central bank to add to the balance sheet of the central bank. That is something no central banker is taught to do. In the United States, in Japan, they did it first because they cut interest rates to zero and the Japanese economy languished. But more than that, deflation was in place. Deflation increases the real value of debt. The huge amount of sovereign debt in the private sector, that overhang, strangled Japan. The fiscal policy, we think, was a mistake. Government spending projects, it did not really make a lot of sense. And just a horrible problem. And to get out of that fix with an overvalued currency, overvalued because the Japanese essentially keep money at home, or used to keep money at home. Home bias, we call it as economists. That currency was so overvalued that the trade flows of Japan were deteriorating, making the debt problem worse. A future 5, 8 years, if that were to continue, bankrupt country who would have to go to the world and ask for money. That's how bad I thought it was. Only way out, lower currency, which happened in Japan, but not without a big change in the central bank and a big change in the policymakers of Japan, and it's not over yet because that currency is still, in our view, overvalued. Well, but once the currency broke, and everyone in Korea knows this, the exporters' prospects were a lot better. The stock market anticipates that. So the Nikkei, Japanese stock market, had a huge surge. And we find that when stock markets do better, sentiment improves. Then there are wealth effects. The cost of capital is lower. Stock markets are a very big part in the financial real interactions in the economy of getting growth going. And so Japan, the first half of this year, did 4%. That was a surprise. Growth has slowed down. As I said, I think the BOJ will have to do more, but that will be part of this improving and faster growing global economy that we are looking at. So with the 4 pillars of the U.S., Japan, China, and Europe pushing up, and central banks behind that as long as inflation stays low, the world economy GDP growth rate that we carry is 3.5% to perhaps as much as 3.75%. And in 2013, that was 2.5% to 2.75%. Part of that is the expectation that I gave you for Korea. Other countries in Asia will grow faster. And when we look around and ask what could go wrong, the question is more, could it be even better? And if it were better, central banks, like the U.S., would become less accommodative faster. That is not their thinking now. So getting back to the central banks behind this, quantitative easing, the increase in purchases of securities for the balance sheet, initially has its impact. This has been true in the United States and true in Japan. It is chronicled by the history of the quantitative easing. Begun 6 years ago by Japan, a lot of stuff in the way, so it couldn't really take hold. But once an inflation target is announced, and there is a almost permanent quantitative easing that goes into place, our view is that will have permanent effects. Temporary measures in policy only have temporary effects. For the U.S., the real move in our quantitative easing came last September when the Federal Reserve tied an open-ended purchases of securities for its balance sheet to how the economy did and how inflation did. And before, they had just had programs with finite time limits and finite amounts, temporary. This one's permanent. Endogenous is the policy response of the United States. We will keep adding to the balance sheet until and unless the labor market shows substantial improvement, the U.S. economy picks up in growth to about the number I said we're having in real GDP, and very low inflation. Right now in the U.S., 0.9% year over year. Turns out to be transitory. That is, inflation begins to point up toward the U.S. inflation target in this country with a dual mandate, two objectives of 2%. So we're behind on the inflation target. We're behind on getting to full employment. The Federal Reserve is in the midst of slowing down the additions to the balance sheet, but they're not going to stop doing it. If they stay on course, they'll be through September, October. They will be no longer adding 85 billion or 75 billion or 55 billion a month to the balance sheet. They will stay with the balance sheet at whatever amount it is. It'll be $4.2 or $3 trillion at that point. And then they will look at the unemployment rate, a rate that will have to be lower than what currently they call their threshold rate, an unemployment rate probably 6 or less. And then they will do the first interest rate hike. And that, we think, early 2015, close to doing that a year from now. If the U.S. does better, it could come fourth quarter of this year. And then when those interest rate hikes occur, they will be very gentle and very quiet, unless inflation over the next year, year and a half, in the U.S. and or the world, has begun to pick up quite decidedly. We don't think that's going to happen. We think inflation rates below central bank targets, including here in Korea, will go on for quite a while, and the central banks will be very permissive. What that boils down to is more growth. Central banks not only encouraging it, but letting it happen. More growth is good for business. More growth is good for the stock market. It's great for the private sector. It's great for sentiment. Not until inflation in the prices of goods and services begins to move up and head toward those targets of the major central banks would we expect them to really begin to try to slow it down. So, if not the basic prospect, our notion is it could be better. And then central banks might step in sooner. Interest rates could move up sharply 2015, 2016. It won't happen this soon in Japan because Japan has, we think, a long way to go on their inflation. The first country something like this might happen, earlier hikes in interest rates, people think, we think would be the U.S., and of course that's positive for the dollar because a strong economy would be driving that. Well, for 2014, 2015 then, the nitty-gritty, the underneath of this half-full wine glass view of the world economy is, we think, highly probable. 3 chances in 4. That's aggressively optimistic compared to the consensus. If wrong, in the U.S., the scenario we have, the major alternative, is something we call delayed takeoff. It would be even higher growth as the economy finally responds to all of this easy money that is in place, doesn't get out of hand because we have fiscal restraint, subtracting from growth in that direction, almost forcing the Federal Reserve to be accommodative longer. The last time I saw something like this was in the 1990s. And so when we back up and we look at asset allocation and where to invest, I think it's clear, equities, equities, equities. So many of the world equity markets are correlated with the U.S. Fixed income, interest rates, except in those countries where monetary policy is being eased. I mean, it could happen here in Korea. Monetary policy might be eased. I think we have a view it will be pretty stable, but the won is strong, inflation is low, but growth is picking up here. It's a tough call. Easier call is that neutral on monetary policy. But interest rates, on average, irregularly so, particularly in the U.S., in our view, and this is a view of May, bear market and fixed income would rise. Not huge, but rise. And in a return sense, equities will produce far higher returns than fixed income for quite some time. That's a reversal of many years where fixed income was the place to be. And cash and equivalent, puny returns. In the U.S., we're zero allocated to cash and equivalent. And we are over-allocated to something called alternative investments for the investors of the world. The U.S. quantitative easing will go on. The use of the balance sheet will go on. The evidence is accumulating that it is working as theory says it should. Not enough sample evidence to be sure. It's very controversial. Questions like how big is the balance sheet? It's too big. What will happen? Don't have a research-driven answer at this point. Japan has made it very clear they're on a 2-year course of doubling the monetary base. That's huge. In Japan, we're watching to see how the banks, insurance companies, pension funds use the funds that the BOJ is injecting as they buy JGBs from everybody. And we are detecting some movement of funds to outside of Japan so that the home bias of the Japanese investors to keep owning Japanese paper seems to be eroding. Why would you, if you're an investor or run investments in Japan, take those funds that the Bank of Japan pumps in the system and buy JGBs? They're yielding 0.7% if you think that the currency might go down. It's a one-sided bet here on the Japanese currency. It may not go down, but it isn't going to go up anytime soon. Maybe 2 years from now, it might, wherever it goes, it might pick back up. And when Japanese financial institutions look around the world to invest, the returns outside of Japan, other than on the Nikkei, will look very attractive. And that's part of what you see in the bond markets of some of the countries whose debt has had fairly low prices. Money is flowing out. You see it a little bit in the flow of funds data on Japan, particularly for the banks. It's kind of masked by a huge inflow of funds that go to equities because the Nikkei is so attractive. So for this year, in the second year in a row, we have the Japanese stock market as our #1 overweight against what's called the MSCI index. It's a global index. And the U.S. equity market remains overweight. Germany is overweight. We have Korea overweight. That was not a winning. I think last year we had Korea overweight. We've upped our weighting to Korea. The stock market returns have been very low here. It should be a much better year for the South Korean stock market. We were wrong on China. China's had a terrible time in terms of the returns on its overall index. And that was a forecast we did not get right. We had China as somewhat overweighted. But the big call for us was the Japan overweight, and the Japanese stock market soared. And we think that's going to continue. So finally, to summarize, what you are hearing today, it's cloudy out there, but it's sunny in here, is a blue sky guy. I look up and I see blue sky for the U.S. and the world. That has not been where I've been for a lot of years. I look up and I say, what are the risks? And I'm looking hard to find the big negative risks. Yeah, you know, North Korea could go wacky. Well, they're wacky already. How much wackier can they get? But I think they could get wackier. Or the Middle East could blow up. But right now, Obama and John Kerry have kind of lucked out, and it seems to be toning down. None of us really trust Syria, Iraq, or Iran, particularly Iran. But in the background is Israel, and they would just take them out. Well, that would shake markets up for a bit. I shouldn't be so glib about that. The Middle East is aflame. It's a mess. Look at all the stuff that's going on out there around the world. Washington is dysfunctional. Despite all that, the U.S. and world economies are getting better. Stock markets had a great year. There is more ahead. It's amazing. It is amazing what goes on in economies, in the private sectors, of the spirits of people in capitalistic business economies in the pursuit of profits, and individuals and consumers in the pursuit of happiness. I will always bet on that. And I hope even in the United States political dysfunctionality, the wisdom of common Americans about the dysfunctionality of Washington will eventually give us some people in Washington who will change it. But if that doesn't do it, then we will get movements outside of Washington that will change Washington eventually for the better. So I'm a young, older man. I'm not a youngster. I've been coming here 20 years, spreading sometimes doom and gloom, sometimes cheer. Today, this is the Tooth Fairy. I'm throwing all kinds of cheer out there, all the happy dust. Forgive the comparison to something that is probably illegal in most parts of the world. I'm sprinkling happy dust out there, so I wish you all well and the best of the year 2014. And may I please be right just one more time. I only ask to be right just one more time. Although next year I may say another prayer and hope that I'm right. Whether I'm right or wrong, I hope that all this comes to pass. Thanks so much for coming.
Well, thank you very much for very illuminating coverage of global economic terrain. Fortunately, the bottom line is the wine glass half full, maybe 3/4 full. That's good news. Bernanke, in his farewell address the other day, had another cautious optimism for the global economy, and particularly U.S. economy, but Alan Sinai is even more optimistic. This is good news, and I really believe in him, and I hope his forecast will turn out to be the most correct one. He gave many numbers and dates, and we'll see next year again whether those numbers and dates turn out to be correct ones. Well, with this, let me open the floor for some comments and questions. Yes, Dr. Kim, please. Okay, and then.
Thank you, Mr. Sinai. It's always good to start the new year with your rather optimistic view of this year. You mentioned a very interesting point in the U.S. GDP because you said we have to take out the reduction of federal purchase. In view of that, the real economy actually performed better than the indications. But we have to also throw in another variable into that, that is the effect of federal quantitative easing, which is about $85 billion a month in the last year, considerably higher than the amount of federal purchase reduction. And therefore, if you look into 2014, you have to think in terms of the net effect after what happens to the quantitative easing. As Dr. Sahong just mentioned, a few days ago, Bernanke said he sees some ground for cautious optimism, which is very similar to the statement Margaret Thatcher said on the eve of a landslide, at which point she said she saw considerable ground for cautious optimism. Mr. Bernanke did not have the considerable ground, he just had some ground. Nevertheless, the projection of the market seems to be that with that statement, Fed is headed to actually netting out all the sequestration this year. You seem to indicate to pursue the unemployment objective, it will continue. So in the balance, what will happen to the U.S. is what will happen to the quantitative easing, how fast they're tapering or not tapering is the effect. What is your projections of quantitative easing for this year? Thank you.
Okay. Why don't you invite a couple more?
Yes, okay, sure.
National Assembly man Lee.
Hi, Dr. Sinai. Again, I agree with previous questioner that it is good to start off a day, if not a year, with your optimism. But my question, although not technical, is within your optimism, what do you think is going to happen to the gap between the rich and poor? And do you think that remains as one of your risks for the future? So basically the question, if it's going to have a positive effect within your optimism, my question is how? Because there are a lot of economists out there that even the growth will not bring any positivity to that gap. And if not, if you have any suggestions for policymakers on how to address this this growing problem.
Okay. Why don't we start with this?
The scenario for quantitative easing is the following. This is a baseline scenario. You understand that we are in uncharted territory. The Federal Reserve knows that, and they are keeping all options open, including doing more, even though they're telling us they're doing less. So we are, roughly speaking, expect them to cut $10 billion. They will start in January. That's the first round, $10 billion reduction in pace of purchases. That'll be $75 billion. That's still quite a bit of addition to the balance sheet relative to the issues of government debt. And we're assuming in each meeting they will announce subsequent reductions in purchases of about $10 billion a month. If they do that, it takes about 9 months. So at the end of September, October, they've stopped adding to the balance sheet and QE3 is over. During that time, because the flow of funds into the long end of the bond market will be less, we think long-term interest rates, 10-year Treasury yield will go up, and by middle of the year we're forecasting 3.5%. Then what they tell us, and I think we want to believe them at the start, this is the intention, this is the scenario, the balance sheet, which would be $4.3, $4.4 trillion at that time, will stay, and the clock will start to tick on that first rate increase depending on where the unemployment rate is. We have a 6.2% unemployment rate in December, which is below the threshold rate for when they start to think about raising interest rates for the first time of 6.5%, but they've changed that. So the 6.5%, which is a biased low measure of the unemployment rate, is not a place where they will raise interest rates for the first time. It would be something closer, we think, to 6 or a little less. So that would be sometime in the first quarter of 2015. Long before that, fixed income markets will price it. So that'll happen more on the long end. So the yield curve should steepen during the second half later this year and into early next year. And then the question is, will that really hurt the economy? It'll scare the stock market. We're going to have a big correction in the stock market sometime this year, I think. We always do in the expansion stage, but it's few and far between. There are opportunities to buy. It'll scare the stock market. Bond yields will go up. Not sure about the currency, but the economy will be driving that action, and so the economy and earnings growth should be better, and it overcomes those initial hikes in interest rates. Between the tapering of purchases and the first hike in interest rates, what we find matters the most to the economy is interest rates, as opposed to the pace of change in the balance sheet. Now, we don't have a lot of history. History will write the story of this after we have a lot more sample information. We are not seeing what everybody feared, which is runaway inflation because central banks print money. And that's something everybody should think about. That theory and instinct that almost everybody had once Japan and the U.S., particularly the U.S., started to print money, does appear to be wrong. There are other forces affecting inflation than just the printing of money or doubling the monetary base, which happen in the economy. The economy has to respond, labor markets have to tighten, and then you get the inflation. But other things are going on. Oil prices are pretty stable. Technology is having an effect. So inflation is running a lot lower than people thought. But that's our scenario for how they end QE3. If what I said doesn't happen, the economy falters, or inflation at 0.9% year over year in the U.S. stays at that number, then they will just stop for a while. Maybe it's at $55 billion a month and keep on adding to the balance sheet. And so far, at this point, we cannot find a lot of costs of adding to the balance sheet for any of the countries that are doing it. The biggest cost is the chaos that goes on in markets when they withdraw it and go to that first hike in interest rates, because the markets on interest rates will spike in fear. Markets are more volatile than economies. And so you'll want to be very careful about your investments when the markets begin to anticipate that first interest rate hike by the Federal Reserve. Your question on, and I'll apply the wine glass to it, on inequality, it's half empty. I didn't mention that. That is a little more societal than economic, but it is also economic. I'm afraid I think the forces of what is at work in the United States are forces that are driving inequality higher, both in income and wealth. That's a potential political powder keg in the U.S. politically would be a huge issue. It's a huge issue now. It's getting worse, not better. And the forces at work, I think, will make it worse. So that the gap between what is commonly called the 1% and 99% will grow wider. I don't see anything going on societally or in policy that will change that. But there are ways to change it, but not until a country has a political problem of size, a country like ours, do we get reactions that will fix it. The literature and research on inequality and growth is very mixed. If you talk to a liberal economist, Joe Stiglitz, who I'm sure has been through South Korea, and he has a wonderful book out on inequality and all of the costs, you come away thinking that it's awful. You talk to others who look at history, and there is an argument that inequality promotes growth. Think of the robber barons of the 1920s. Think of the billionaires in the United States that have made hundreds of millions and billions of dollars on new technology, and how much that has increased the disparity of income and wealth. But what they did and how they got wealthy and how they increased the Gini coefficient and the inequality was very beneficial to the economy. Facebook, the young guy who runs Facebook is giving a lot of money to charity now. Took Bill Gates a while, but he's giving a lot of money to charity. We've got billionaires in the United States that are contributing half of their net worth to charity. Some of them, people like Leon Cooperman, are managers of money. And that money finds its way into more innovation and entrepreneurship because it finances those kinds of activities and actually helps growth. It's not so crystal clear, but as a societal issue, it is really, I think, negative. I have to say, half-empty glass on that one. Sad to say that.
Yes, yes. And then Professor Hong.
저는 케미컬 에너지 투자자원의 차홍순 대표입니다. 말씀 잘 들었고요. 질문은 두 가지입니다.
잠깐만.
질문은 두 가지인데요. 첫 번째, 교과서적인 질문일 수 있는데, 경기 팽창 후 미국이 인플레이션을 두려워한다고 했습니다.
Is not working.
Please speak in Korean. Let's see if I think we have it now.
오케이. 미국이 경기 팽창 후에 인플레이션을 두려워하고 있는데,
Channel 1, thank you. Got it. Thank you. Sorry. Yes, that's it. Sorry.
미국이 양적 완화 후에 경기 팽창, 인플레이션을 많이 두려워하고 있는데 교과서적으로 왜 미국이 인플레이션을 두려워하고 있는지, 그래서 경기 수축을 하려고 하는지 인플레이션의 두려움에 대해서 말씀해 주시면 감사했고요. 두 번째는 다 미국의 4대 축이 이제 미국도 경제 성장률이 올라가고 유럽도 경제 성장률이 올라가고 일본도 올라갔는데 왜 중국만큼은 과거 10%에서 7% 떨어지는지, 왜 중진국이 함정에 걸렸는지, 중국의 경제 성장률이 왜 떨어진다고 보시는 건지 7%대로. 네, 감사합니다.
Okay. Dr. Hong. Yeah.
Thank you, Mr. Dr. Sinai. Last May and June, due to Bernanke's dispute on tapering, most of emerging economies especially suffered under the deficit of current account. We call it the fragile five or so, have been quite fierce suffering and troubles. And this time again, since December, as we see, most of these emerging economies are suffered under the new type of impact of this tapering. And in these occasions, what do you recommend to these fragile fives and the other country like China? Even for Korea, we should prepare and cope with the new coming of tapering effect and so. In this occasion, what kind of suggestion and recommendation do you think you could provide for these emerging economies like Indonesia or India, and how about China and Korea about these occasions? Yeah, that's.
Okay. The first question regards the inflation. His question was in textbook terms, why people are so concerned about the possibility of inflation. So what's wrong with inflation? That's the question. And the second question was about China. The Chinese economic slowdown might have to do with mid-income trap. Is that has anything to do with mid-income trap, or is that cyclical?
Right.
That's just two.
The question about tapering and what that might imply for business and for investments. When the U.S. started an aggressive program of adding to the balance sheet, and very open-ended, things happened in asset prices that should have happened. The dollar went down. That means a lot of currency values went up, and export countries, open economy countries whose currencies rose, including Korea, against the dollar, that hurt export companies. And the effect of the U.S. reduction or printing of money was inflationary, not so much for the U.S. but other countries, and that was a problem for policymakers, and they complained. But the U.S. has gone on and went on and printed money. Now we're going into reverse gear. So you should expect the dollar to be stronger against the country's currencies that you mentioned, and those currencies to be weaker, and that is helpful against the U.S. to those countries in their trade with the U.S. to help their exports. And it's trickier when you look at dollar-yen because we think the yen will go down and the dollar will go up, so from both sides. And euro-dollar is trickier, but against the emerging world, we should see some reversal of the investment trends that we saw last year and of the benefits to business of lower currencies in those companies, but with lags. It's not fully symmetric, but it's in that direction would be my answer. On the first question about inflation, there's a real question about the perception that inflation would rise or run away on the high side on the printing of money. What conditioned that view was the German hyperinflation experience of the 30s. And what conditioned that view in the United States to a large extent was the monetarist view, which is still deeply held in a lot of academic and central bank circles, that printing money will be inflationary. Now, we know it's true in a fully employed economy. If you drop money from the sky, that's the famous helicopter notion of dropping money from the sky, outside of the banking system, don't give it to the banks, just drop it out there on the sidewalks. People pick up the money. If it's a fully employed economy, they spend it, inflation goes up. And so the printing of money leads right away to inflation, and then inflation begets more inflation and expectations of inflation, and it's a runaway situation. But the world is not fully employed and wasn't fully employed when the central banks began to print the money. Now, it's interesting to me that when in the U.S. we first started to do it 4.5 years ago, every single talk I gave, every single policymaker I spoke to was worried about runaway inflation. And I said, well, let's worry about that after the economy recovers because we're in recession and the world isn't doing too well. So I would think the first thing that we ought to worry about is do we get out of the recession and unemployment rate come down rather than thinking that immediately we get inflation. Now, for 4.5 years in the United States, we have had declining inflation with the printing of money. In Japan, they had sustained deflation with the printing of money. What's going on? So is the model or perception that everybody had, and from your question still has, right, or is the world right? Or is it some combination of the two? So I have the following reaction when I see something that models or paradigms, my models included, happen that the model doesn't say ought to happen. Do I assume the model's right? That's what all the Nobel Prize winners at LTCM assumed in the late 90s, and that whole thing collapsed because we learned there and in the crises that all these models are fallible. They're based on history. So I immediately, when I see something that's at variance with my own theoretical perception, with that of lots and lots of people, policymakers, when the world evidence is different, I go looking for why. And I find most of the time that the models are wrong, in retrospect are wrong, the paradigms are wrong. If you know how they get created by data from 10, 20 years of history by we economists. We pump it out in the world. We are very persuasive, some of us, so the world believes us. And there you are. Milton Friedman lives again on this running away of inflation. It just hasn't happened. So what's going on? Well, one thing that is going on that's conventional is the economies around the world have a lot of slack. Labor markets are still weak no matter what the unemployment rates are. And we have plenty of places where we have pretty good-sized output gaps, which means we can grow a lot more, wipe out the gap before we worry about inflation. We also see that wage inflation is pretty low. That's a consequence of weak labor markets. And then we have speculative money on commodities, which is kind of betting on disinflation or weak inflation. And then we have technology. Technology. That's my new suspect for why it's happening. Because, in the United States, I don't know anybody, well, yes, people buy outside of Amazon.com, but you got this nut Jeff Bezos who has got a company that's losing money, that's got an infinite PE ratio. The revenues are growing like mad because he's undercutting everyone in prices, and they sell everything and they deliver it free the next day. It's got to be doing something to pricing and the transparency of pricing and the competition that exists globally. So I don't think we know the answer to why the low inflation, but it is a big puzzle. And look at the inflation rate here in Korea. 1.3% is our number for 2013. We're forecasting 1.5. The target is 2.5. U.S. we're running 0.9. The target is 2. In Europe, running, I think last number was 1.1. Their target is 2. Japan is 1.2 year over year. Their target is 2. Something different is going on inflation, systematically lower almost everywhere. The UK is still above their target, but coming down. I don't think we have the answer to it yet. But right now, the world is telling me that the paradigms and the initial thought is just wrong. And so I encourage decision makers, until proven otherwise, because the evidence of the world is right, my models are wrong. That's what I have found 9 times out of 10. And that's why immediately when there's a dichotomy, when there is a disconnect, I immediately go looking for why. I don't have the answer on inflation yet, but I think it's out there, and maybe the next year we'll find it. Or inflation will suddenly snap back and the question will go away. The Federal Reserve assumes in their move toward tightening that inflation is low and it's transitory and that we will move up toward 2% over the next 2 or 3 years. What do they do if we don't, given that that's the target? Answer: interest rates don't go up very much, if they go up at all. That's just the way they're playing the game.
Yes, the question was mid-income, the trap, or is a cyclical Chinese economic slowdown? To this level to 8%.
Well, what growth rate do you want to give me for China? You want to give me 3%, 5%, 7, or 8, or 9? On the GDP growth rate that is produced by China, we are pointing toward 8% over the next year or two. So it's a sideways to somewhat up movement. On that GDP growth rate, we did not have a hard landing in China. On the innards of China, some of the property issues, the banking issues, certainly China did have a hard landing, and these still plague the country. A very interesting country in the sweep of history. Long run, it's impossible not to be positive about how China will do in the economy and politics, and eventually the Chinese stock market will do. But there are adjustment difficulties. On a GDP basis, sideways to somewhat higher for that country. The country is opaque, it's not as transparent as we would like, And my kidding about the GDP number reflects the fact that we don't really believe the numbers they put out in China, but that's what we have to go by.
Okay, with this we have to end. Actually, Dr. Sinai has to give the lectures at the some institutions in Seoul, and then he has to fly to Tokyo this evening. Again, he will meet with the Kuroda and many other policymakers there. Well, again, it's good to have Dr. Sinai with a very optimistic view of the global economy, and his track record is very good and accurate. So I'm sure we'll have a good year. This not only in Korea but globally. But he gave many messages, but one of the important messages I picked up for the Korean business community is that yen will keep weakening and won will keep strengthening. So the option for Korean businesses is cost downs and do more structural adjustments and work on and strengthening competitiveness so that Korean firms and Korean economy can take advantage of the Japanese economic growth from real economic side, although we have problem with the financial side, but all in all, Japan is the third largest economy in the world, so we can benefit if we are wise enough by having the structural adjustment implemented properly. Well, with this, we have to end, and please join me in thanking Alan Sinai.
Thank you.